The headlines call it the moment HYPE went legit. In under a month, 3 asset managers raced out competing exchange-traded funds around it. A Wall Street fee war over a token most people still can't explain. But here's the tension worth sitting with. The ETF is not what's driving HYPE. And the thing that is driving it is something an ETF can't actually hand you. We covered Hyperliquid itself in another video. The decentralized exchange that put a real fast order book on-chain, the way Binance or Coinbase run one, but without a middleman holding your money. This isn't that. This is about the token that sits on top, called HYPE, and the funds now racing to wrap it. The race started in mid-May. On May 12, 21, shares listed a spot HYPE fund on the Nasdaq under the ticker THYP, charging 0.3%. 3 days later, Bitwise went live on the New York Stock Exchange with BHYP, no fee for the first month, then 0.34%. And in early June, Grayscale launched HYPG, also on the Nasdaq, at 0.29%, the lowest of the group, undercutting both rivals by a hair. If that pattern sounds familiar, it should. It's the same fee war that broke out when the first Bitcoin and Ether funds launched. Once the product is basically identical, price becomes the weapon. So what do you actually own when you buy one of these? Not one HYPE token per share. You own a slice of a fund that holds a pool of HYPE, and your claim on that pool is proportional, minus the fund's fee, which gets skimmed from the holdings over time. That part is standard ETF plumbing. What's new here is staking. HYPE can be locked up to help secure its network and earn a yield, and these funds stake the HYPE they hold. 21, shares through outside custodians, Bitwise through its own setup, Grayscale leaning hardest into it. Those staking rewards can flow back into the fund and offset part of the fee. That's a real step beyond the first Bitcoin ETFs, which just sat on a pile of coins. But read the fine print. The funds say staking yield may be reflected in the fund's value, not that any amount is promised. Now the part the headlines skip. Why is HYPE, the asset, doing this at all? While Bitcoin, Ether, and Solana all fell hard this year, HYPE ran the other way, up triple digits. The reason isn't the ETF. The funds are riding the move, not making it. The reason is a mechanism called the Assistance Fund. Every trade on Hyperliquid pays a fee, and roughly 97% of those fees, pushed toward 99% by a governance vote, get routed automatically into buying HYPE on the open market, every single day, with no one pushing a button. It has spent more than $1.3 billion doing exactly that, at a pace near 7% of the token's market value a year. That's 4 to 5 times the buyback intensity of Ether or BNB. That is not how a typical token behaves. It behaves more like a company running a relentless stock buyback, where the price is mechanically tied to how much business the platform does. And there's a second pipe feeding the same engine. Remember the Coinbase and Circle deal we mentioned? The one wiring USDC infrastructure directly into Hyperliquid. The reserve yield that stablecoins throw off, the interest earned on the cash backing them, is being steered back into the protocol and into those same buybacks, on the order of $100 million a year that used to go somewhere else entirely. Trading fees and stablecoin yield, both aimed at the same token. Which brings us back to the wrapper. An ETF gives you clean, regulated exposure to HYPE's price, and maybe a sliver of that staking yield. What it does not give you is the flywheel. The buyback accrues to the token's market price, and the fund simply tracks that price and charges you a fee to do it. So the ETF is a straw into the same milkshake with a small leak. Convenient, legitimate, easy to buy in a brokerage account. But it's the distribution, not the engine. And the engine carries real risks the wrapper can't smooth over. Those fee-funded buybacks sit in a gray zone under U.S. securities law, where a regulator could someday argue they look like paying holders. The buyback rate is set by governance, not carved in stone. And fresh tokens keep unlocking. Adding supply the buyback has to keep absorbing. So, when you hear that Wall Street just legitimized HYPE, hold it at the right angle. The ETFs didn't create the value. They showed up to wrap a flywheel that was already spinning. The on-ramp is the distribution. The buyback is the engine. Know which one you're buying. We cover crypto on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.